everyone, thanks for tuning in. We're going to make a quick little video with these new mortgage rules and play a little game in today's video. I bet you didn't know. That's what we'll call this video. I bet you had no idea. Let's use my dad as person A and we'll use my brother as person B. These aren't the real numbers, I'm just kind of making something up. But let's say my dad, hardworking guy, retired about 15 years ago, bought some land, he just bought a new house, and let's say that house is worth $1 million. He calls me up and says, son, I just want a measly $100,000. I've been working my whole life and I now have $900,000 down as a down payment. Makes sense? You guys might know a lot of people in this position. I have a very big down payment and this is all I need for a mortgage. Now, my dad expects the very lowest interest rate possible, doesn't he? He's worked hard, he has leverage. Hey bank, I have $1 million house, I only need a $100,000 mortgage, give me your best interest rate. Now this is what we have heard years and years for the last, 50, 100 years in banking. Now, listen to this. Let's say my brother, person B, let's say he works for a painting company, he's buying a $100,000 house, he has just raised 5% down, and you can tell by his deal that he's just living paycheck to paycheck. He's just squeezing into this house with 5% down. This person, my brother, will be offered a lower interest rate than my dad. That's right, people. The more you put down does not mean the lower your interest rate anymore. And every single person that's calling in, that's where they're surprised. How is this possible? How can someone that's just putting the minimum down in Canada get a lower interest rate than the person with a very large down payment? Here's what we're going to explain. CMHC, insurance. Do you understand what that means? So if you get a mortgage through, it doesn't matter, one of the big 5 banks, okay? If you get it from a trust company, credit union, it doesn't matter. In Canada, if you put less than 20% down, then it has to be insured. Now what that means that if you default or flee the country and your house gets sold, that bank cannot lose a dollar. They are fully insured. Therefore, this person has a very low risk mortgage because it's insured. This person, my dad, although he only needs $100,000 on $1 million, very clean deal, believe it or not, he can't get insured anymore. That's what the rules have done, people. You may not have known it, but before when you got a mortgage with 50% down, that's fine. But the banks and the lenders were still insuring it in the background, so it was double protected. For example, you may have heard lines like, bulk insurance or mortgage-backed securities. Those are some of the topics you hear. So what I mean by that is if you're putting more than 20% down, then that is a different risk level. Therefore, it is a little bit riskier than the insured person. Like I said, I bet you didn't know with the new rules, and it is a big impact. So whether you are up for renewal, buying a house, or you want to clear out some debt, run it by a mortgage teacher first. Look us up at mortgageteacher.com.